Hello and welcome to Chartbusters. I'm Nigel D'Souza and joining me as always, Mangala Malu. Well, we've got a couple of management since it's earnings season, so let's get straight to that. Let's get chatting with the management of Mphasis. We have Mr. Nitin Rakesh as well as the CFO of the company, Manish Dugar, who joins us. Hi, gentlemen. Good morning from here in India, and thanks so much for staying up for us and wishing you all and your families as well a happy Deepavali in advance. Well, let's talk about business then. It appears, the street is a little bit disappointed with the numbers. So let's focus first on your mortgage part of your business. What portfolio of your business in terms of percentage comes in from mortgage? And also, are we witnessing higher furloughs than normal?
So I think overall, there's definitely some impact from the line of business you talked about. I think we haven't declared the exact percentage, but the part of the business within that mortgage LOB that is really sensitive to interest rates about low single digits. So we have seen some of that impact play out. We think we have a portfolio diversification mode there that helps us actually sustain some of that momentum that we've built over the last few quarters. And as this uncertainty gets a little bit more stable, we think that's a growth business all over again. So from that perspective, I think there's definitely a long-term growth view mindset on that business as well. On the furlough side, I think so far there was specific client issues that cropped up. We haven't really gotten any more indication than seasonality that plays out in Q3, so there's nothing specific to call out for on that front at this point.
Right, and what about Europe? 9 to 10% of your revenues. You have a revenue growth of around 10.6% year on year here. What's the outlook for the European business? How are the macros? And in light of that, is the deal win pipeline of about $300 million sustainable?
I think, again, Europe is a business that grew really rapidly. It's definitely been a certain degree of, given that we are more UK focused within Europe, there's a certain degree of uncertainty there that has cropped up, as you know, with all the events that have happened. So I think we know, obviously, currency plays an impact there as well. So we'll continue to see how best we can pivot and stay focused on a set of customers there that we can service and we have opportunity and room to grow with, while also building a new pipeline of customers. As such, we don't think that should derail the momentum from a TCV or a pipeline standpoint. Our pipeline is actually up 18% quarter over quarter, TCV wins of 300 million plus, despite the macro environment, despite the mortgage slowdown. Very pleased with that. And I think pipeline is a lead indicator. As long as the pipeline continues to grow despite deal closures, the TCV wins and the revenue growth will follow.
All right. I want to ask you about the rupee depreciation. We here in India, some part of us or some part of the stock market at least is fretting. Who would have thought the rupee at close to around 83 odd? But that'll be a bit of a tailwind, I believe, for your business. If you could quantify what was the benefit of the rupee in the past quarter, and also since we have a bit of a tailwind in this on this front, why not go ahead and up your margin band? I think you're in that vicinity of around 15.25 to around 17%.
As we have mentioned earlier, we believe in the philosophy of investing for growth while maintaining margin in a narrow band. So what gets reported as a margin is a puts and take of various investments that we want to make and the tailwinds that we have. As you rightly said, currency is a tailwind. We have a treasury policy where we want to make sure that we have visibility to a conversion rate for a reasonable period of time, typically over the next 4 quarters. So a large portion of what we converted to INR this quarter would have already been hedged, which was at a rate better than what we were getting in the previous quarter. So we would have had that benefit flow into the P&L. But it did not flow into the P&L to the extent of what the spot rate was, because the expansion in rupee dollar conversion was much more than what one would have anticipated. So yes, the margin expansion does happen with exchange. Exchange is a tailwind for the margin, and it's a continuous phenomena for the industry. And a large part of that was baked into our plan because we had visibility to what it will look like for quarter 2.
So the first couple of quarters, you've done margins of what, 15.3%. Your overall guided band is 15.3 to 17 odd percent. The second half, should we see it moving towards that 17% mark?
The reason why we gave the guidance of 15.25 to 17 was twofold. One is we were coming out of a quarter 4 when it was 15.2 and the industry was all worried about margin contraction. So we wanted to indicate that one, we will be ahead of what quarter 4 is at a minimum, which is why the 15.25. And the range was given that large because there were uncertainties in the macro leading to us not having surety of whether the supply costs will be easing or whether it will continue to be stressed. While we have seen initial signs of supply easing out and attrition levels moderating, but it is still at a level which is we would like to see going down. So as things progress, we have enough tailwinds, which gives us confidence to maintain that lower end. But whether those tailwinds can translate to an increased reported margin will depend on whether the headwinds are mitigated. And, they are getting mitigated, but not at the pace at which we would like it to.
Yeah, the street is hopeful that, the worst of attrition is behind for most IT companies. My colleague and me, sometimes we wonder whether we're in the wrong industry, with the kind of attrition you guys and the kind of hikes coming about. But that discussion for another time. Final question then, there was some hope that there'll be price increases that can get pushed through. Is that unlikely now?
Not really. I think, Nigel, at this point, the pricing environment is, I would say, stable to still tailwinded for the right type of skills and the right type of services. So I think there has definitely been realization at the client level that we are in an inflationary environment. They're seeing it in their business. They're seeing it in their employee pools. They're seeing it in their attrition levels. I think as we head into 2023, if the uncertainty gets worse or the macro gets worse, then I think we'll start, using the playbook of, vendor consolidation driven wallet share gains. And at that point, I think there may be a little bit more competitive intensity on pricing. But at this point, so far, YTD current quarter pricing environment is fairly stable, and in fact has actually been helpful in mitigating some of the headwinds from wage inflation.
Do you have any maths on what the wallet share is with regards to all your clients, how it has increased or moved over the last couple of quarters, what the outlook is here?
I think if you look at our client metrics, top 5, top 10, next 10, new clients, all have actually grown very, very healthy in the 27, 28, 30% range. New client business actually grew just on a Q2 YY basis at 53%. That is highly indicative of the fact that in almost all key relationships, we've actually continued to gain wallet share. And of course, it's a portfolio approach, so we'll continue to deploy a playbook. We, in fact, detailed that out at great length in our earnings report an hour or so ago. So I think the playbook definitely calls for aligning behind where the client budgets are moving, which is largely in favor of transformation projects, cloud and data standard as 2 key areas, as well as in helping them shift the dynamic between run the business and change the business spend. And the third one really is, as we see opportunities for vendor consolidation, wallet share gain becomes a really key metric by deploying cost takeout and other measures as well.
Okay, all right, gentlemen, Nitin as well as Manish, it's been good speaking to you all. You'll have had a long day. Have a good rest, and we look forward to chatting up with you all rather soon. And as I wished all earlier, happy Deepavali to you all, to your entire team and your families as well.
Welcome back. It's the Nifty Bank, which is batting for the bulls with some gusto. It's at the high point of trade with a gain of almost 650 points. The big contributor today, of course, while it's Axis Bank, we've seen a big move come by in ICICI Bank as well, which has moved to the high point of trade. And Kotak reports its numbers tomorrow. So that is the other one we're watching out for, along with ICICI Bank. So both those stocks doing well. But another stock on our radar is Nelco, trading higher after reporting a good set of numbers for the second quarter. PJ Nath, who's the MD and CEO at the company, now joins us to tell us a little more about the quarter gone by, but more importantly, the business going forward as well. Thanks a lot, Mr. Nath, for joining in. There was a dip in the revenues quarter on quarter, even as there was an improvement in the revenues year on year. Could you tell us, was that on account of delay in execution of contracts? How are these revenues likely to pan going forward?
Yeah, good morning and good afternoon. Thank you for getting me in. We are in two types of businesses. One is in terms of satellite communication services. The other is in terms of satellite communication system integration business. System integration has got a slightly lumpy nature in terms of revenue. So quarter one was one quarter where we had a high revenue because of system integration projects. But if you really see from a year-on-year perspective, we've grown by 23% on revenue over the same period last year. So therefore, overall, the business is doing quite well. The satellite communication services is growing quite effectively. In fact, when you look at 23% year-on-year, it is entirely on satellite communication services and without any system integration, because we didn't have any major system integration project revenue in last quarter same time.
Okay, hi, Mr. Nath. Firstly, wishing you, your family, everyone at Nelco as well a very, very happy Diwali, and
Thank you so much.
may it be a good year personally as well as professionally for you. Let's talk about
Thank you so
business, though. You're clocking that 75 to around 80 crores odd. What should that be the run rate that we should work with for this year? And for the year, what kind of a revenue number are we looking at? If we go at approximately this 80 crores odd, then you're going to be winding up at around 320 crores. Can you better that? And also margins. Well, last year you did close to around 19.4% or thereabouts. You're currently in that vicinity. Should we work with that number?
Yeah, the margins would be around the same. I think last quarter when I came for the interview, there was a bit of a dip last quarter by 1 percentage point and a lot of queries. So I had said at that time that the EBITDA margins would be in the range of 19 to 20%. I think we'll continue at that level. In terms of your other question, in terms of whether the clocking of 75 to 80 crores is a realistic number, answer is yes. But yes, as we go along, our revenue will go up. Now, what would the effective number? I would not like to really.
How far? Let me guess then, Mr. Nath. 320 crores at least? At least?
Well, near about that, I think we should be there.
All right, near about 320 crores is what you're guiding for. Just wanted to understand about the margins as well. I mean, you had earlier made investments, etc., but now a large part of your raw material or the inputs are also imported. So could there be an impact of rupee depreciation on your margins going ahead?
Yes, all our equipment, bulk of our equipments are imported. At the same time, we also have a fair amount of export revenue. So as of today, we have been shielded against the rupee depreciating so far.
What's your net exposure? What's your net exposure to the rupee? I mean, how much is the imports? How much is the export? Yeah.
As of now, it is kind of nullified so far. So we do not have any exposure so far.
So X of that, what are your margins likely to be going forward?
Pardon me?
X of the rupee, now you're saying that is nullified. What are your margins going to be going forward? Because back in the day, they were dipped because, a lot of the one-time expenditure that you would make on improving your infrastructure, all of that. Now that is behind the company. Going forward, what kind of improvement can we expect?
Yeah, I think as I said, our EBITDA levels would be around 19 to 20%. I think we'll continue at that level.
Okay, Mr. Nath, just to get back on that rupee point, at what level does it become a worry? You're saying that you import all your equipment and there are some exports as well. So they're pretty much nullifying each other. Is that some level where that turns unfavorable for you?
No, for the current year perspective, we don't see any change in that scenario.
Yes, because you've hedged all you've hedged your book. So
we don't see any challenge for this year.
And this you've hedged till the end of this year, that is till FY23?
Yeah, I would not like to say beyond that, but I'm just saying for this year perspective, we don't see a major threat because of rupee depreciating.
Okay. Just to focus on your top line, how much of your money came in from maritime and how much of it came from in-flight communication?
I see between in-flight and maritime communication, we call it IFMC. IFMC contributes to about 23 to 24% of our total revenue. So this is where the breakup is. And between aero and maritime, the breakup would be around 70-30.
70 would be aero and 30 would be maritime.
That's correct.
But we understand that, maritime would be almost a 500 crore opportunity going forward. I mean, by when does that happen? And what does your overall book look like at that time, say, 3 to 4 years from here?
See, there is a lot of growth expected in the maritime industry. As of now, the bulk of the revenue that we get is from international vessels coming into the country when they're in the Indian waters. We believe that the Indian shipping industry will also take off in the next few years. And that is where the growth would be quite high. There are other markets like fisheries, which will open up in due course once the regulation permits us to get into newer bands like L band and S band, which helps in terms of getting the right kind of equipments for that kind of a market. So at that time, we'll see a significant growth in the maritime sector. But to my mind, that will take another 2 years or so before we really see a huge growth. But yes, as a company, we are growing our maritime revenue as well as aero revenue year on year.
All right. And there was a bit of an issue on the semiconductor front, not for you, but for the entire industry and various industries that were dependent on semiconductors. The worst behind us on that front?
Yeah, we are more or less behind that, and off and on there are some challenges, but as of today, that is not a major cause of worry for us. But we are keeping a tight watch on how the equipments are getting manufactured and then delivered to us.
On airlines, you know, the big opportunity was maybe internet in Indian Airlines. Currently, we just have Vistara offering that service. Are you looking at any of these partnerships here? And what kind of opportunity could that provide you, say, you know, from a long-term standpoint?
See, as of today, the entire in-flight connectivity is happening on the international aircrafts. Even Vistara is using for the international aircrafts and not within the country. We believe that the domestic aviation sector will also adopt in-flight connectivity services. But our view is that it will take another year and a half, perhaps, before it really becomes a live service in the country.
All right, maybe at some time we'll you know, do an interview from the aircraft. All right.
Should be possible. Yeah, if you're on an international aircraft, we can still do it today.
No, I don't think we'll go international anytime soon. But domestic, I would look forward to, you know, speaking with him and maybe tweeting to each other as well, Nigel.
Absolutely. All right, it's been good chatting with you, Mr. Nath. And on that optimistic note, let's hope things move at a better space for better customer satisfaction as well as for your business as well. Wishing you a good day and a good quarter ahead as well. Well, we're holding with gains. The mid-cap index underperforming a little bit today, not the breadth of the market, but if you look at the mid-cap index, is up only around 0.2%. But as we always do, let's shift focus to our special segment where we get you a few ideas for profit from Money Control Pro. Anubhav Sahu of moneycontrol.com joins us to talk about a stock that he's tracking very closely. Anubhav?
Today, we are talking about Aarti Industries, which is the leading manufacturer in the benzene-based value chain. Now, notwithstanding recent quarterly results, stock has corrected by about 41% from its 52-week high. Now, one of the key concerns has been demand slowdown in textiles and FMCG end markets. Shortage of key raw material, nitric acid, is another concern, though companies deliberating on backward integration. Further slowdown in European demand is another factor to watch as it contributes nearly 10% to revenue. Now, having said that, facilities linked to long-term contracts are showing traction. And all these facilities can add nearly 15% to the top line in fiscal year 24. Further, companies undergoing a huge capex cycle in the next 2 years. Capex outlay is about 3,000 CR, wherein company would be focusing on downstream products in existing chemistries and newer chemistry value chains such as chlorotoluene. Now, targeted end industries range from pharma, agro, polymers, and pigments. And to tap the opportunities, company would be sweating its existing land bank at Dahej and Jagadia. Thirdly, valuations have been reasonable. In fact, they have turned reasonable, and stock is trading at 14 times EV by EBITDA for fiscal 24. We believe investors looking to have an exposure to a vertically integrated aromatic chemicals company can watch out for it post the demerger of pharma business.
All right, Anubhav, thanks a lot for that. With that, we wrap up on this edition of Chartbusters with the news that the market's doing okay. The Nifty Banks mildly come off the highs, as is the Nifty, but we're in fine fettle. Stay tuned. Trading Hour comes up next.